What is a bond? Here we're diving into an essential financial topic, bonds. So, when you hear the word bond, what comes to mind? Maybe secret agents in movies or something related to loans? Well, in the world of finance, bonds are actually an important tool for both governments and corporations to raise money. So, let's break it down together. First, let's define what a bond is. A bond is essentially a loan, but instead of you borrowing money from a bank, you're the lender. When you buy a bond, you're lending money to the entity that issued the bond, which could be a government, municipality, or a corporation. In return for your loan, the issuer promises to pay you back the full amount on a specified date, known as the maturity date. Until then, they'll also pay you interest, typically at a fixed rate. This interest is why bonds are often considered a steady, predictable form of investment. Now, why do entities issue bonds? Governments might issue them to fund public projects like building roads or schools. Corporations could issue bonds to finance new projects or expand their business. By selling bonds, they can raise large amounts of money without diluting the ownership stakes of existing shareholders, which would happen if they issued more stocks. Next, let's talk about the different types of bonds. You've probably heard of government bonds, like U.S. Treasury bonds, which are considered extremely safe investments because they're backed by the full faith and credit of the U.S. government. Then there are municipal bonds, issued by states, cities, or counties, often to fund local projects. These can be attractive because they sometimes offer tax-free interest. Lastly, there are corporate bonds, issued by companies. These can be riskier, but they often offer higher interest rates to compensate for that risk. So, how do you make money from bonds? There are two main ways: interest payments and selling the bond for a higher price than you paid. Bonds pay interest at regular intervals, which can provide a steady income stream. If market interest rates fall, the value of your bond might go up, allowing you to sell it at a profit. However, if rates rise, your bond's value could decrease. This inverse relationship between bond prices and interest rates is a key concept in bond investing. However, remember, bonds aren't risk-free. There's the risk that the issuer might not be able to pay back the loan, known as default risk. There's also interest rate risk. If rates go up, your bond's value might go down. And inflation risk. If inflation rises, it can erode the purchasing power of the interest payments. Despite these risks, bonds are often considered a more stable investment compared to stocks. They can provide steady income and are an excellent way to diversify your investment portfolio. Plus, if you're investing for the long term, bonds can help balance out the volatility of stock investments. So, bonds are a fundamental part of the financial world, offering a way for entities to raise money and for investors to earn steady income with relatively lower risk. Whether you're just starting out in investing or looking to diversify your portfolio, understanding bonds is essential. Remember, investing always comes with risks, so it's important to do your research and consider your own financial goals and risk tolerance.